Good morning, everyone. This is Chris Lawton. I'm Director of Knowledge Exchange with Farm Credit East, and I'd like to welcome everyone to our 2014 Dairy Outlook webinar. Thank you for joining us today. Before we get started, there's a few technology tips to keep in mind while you're viewing our webinar. All attendees are muted throughout the presentation to minimize background noise. Every once in a while, you'll want to tap your mouse so that your screen doesn't go to sleep during the presentation. There will be time for questions and answers at the end of each speaker. Questions can be typed in at any point during the presentations, and they will then be asked of the presenter at the completion of their presentation. To send in your question, click on the red arrow to expand the GoToWebinar control panel, which is typically found in the upper right-hand corner of your screen. You will then see a text box where you can type in your question and send it in. A recording of today's presentation will be available on farmcrediteast.com/webinars for playback at a later time. Before we begin, I'd also like to invite everyone in attendance to participate in our 2014 Pulse of Agriculture survey. Participants can enter into the survey for a chance to win a $250 Visa gift card. Northeast producers are invited to share their thoughts on the current agricultural business environment and their outlook for the year ahead in the survey. Visit farmcrediteast.com and look under latest news for more information and to participate. So with that done, I'd like to introduce our first speaker, Dr. Mark Stephenson. Mark Stephenson is the Director of Dairy Policy Analysis at the University of Wisconsin. In this position, Dr. Stephenson conducts and coordinates research and outreach activities related to the dairy industry. He's involved in applied research at the firm level, including milk assembly costs, processing costs and efficiencies, new processing technologies, and new dairy ingredients. He is also active in sector-level performance, including dairy policy and milk price forecasting. So please join me in welcoming Dr. Mark Stephenson. Go ahead.
Well, thank you very much, Chris. I appreciate that, and glad to be joining folks from the Northeast again. In fact, I was back there the other day, and it was kind of drippy and dreary, so I'm back here enjoying some snowfall this morning. But I did want to talk about the dairy situation and outlook today, and want to go through a few things. Points to cover would be the demand for dairy products, and that has both a good news and bad news component to it. As a true economist, I'll cover the bad news first. I want to talk about our competitors for world trade in dairy products. A few years ago, those would have been words that we wouldn't have even thought of putting together as we were minimally involved in world trade, but that's not the case any longer. I want to talk about the U.S. milk supply because that has important implications for prices and milk production costs that give us the margins between milk and particularly feed costs. And then finally, my price forecast. Oh yeah, and I'll make at least a comment or two about the Farm Bill because we may have a little bit of movement there, so I'll talk about that at the very end if I have time. I guess the bad news, one of the pieces of bad news at least, is fluid milk sales. We've been watching fluid milk sales on a per capita basis that have been declining here in this country for a long, long period of time. But our population growth had been enough to kind of offset that to the point that we had slightly increasing or maybe stable or level total fluid milk sales. And you can see here that even over this decade of 2000 and through 2013, the mid part of 2013, we had fairly flat sales of fluid milk until we got to about 2010. And at that point, we've seen pretty dramatic declines in total sales of fluid milk. Very important for areas like the Northeast, where that has composed a fairly large proportion of the federal order blend price. And it doesn't look like this is going to turn around anytime soon. Last year, we passed a number that was a nice round number of 20 gallons per capita. We fell below that for the first time ever, and that 20 gallons per capita of milk consumption caught a few headlines last year. But you can see that this is a trend that's got a lot more movement to it than simply that threshold number of 20 gallons. So fluid milk sales have been disappointing, to say the least. Now, we do think that part of fluid milk sales being challenged is certainly that beverage space has a tremendous number of competitors in it, But we also recognize that some of the fluid milk sales loss may be because we've had some category shifting going on. In other words, people are still consuming dairy products, but it's not being consumed as fluid milk sales. And I'll talk a little bit more about that in the next slide or two. If you look at per capita cheese consumption in the U.S., you can recognize that this has been the real growth engine of sales for milk in this country over the last 30, 40 years. Boy, since 1970, we've increased per capita consumption of cheese in this country from about 10 pounds to well more than 30 pounds per capita. The last few years, you may notice that maybe since 2008 or 7 or so, it's still increasing, but at a slightly slower rate. And there have been some people who've said that maybe we've simply got pizza fatigue at this point in time, or maybe we've eaten about as much cheese as we want to. There's no alarm here. There's no sales decline. But this category that's provided so much growth for the dairy industry now looks like it's reached a point where it's going to be a little bit harder to push those sales further. Yogurt has been one of the stories, of course, that is not brand new to the Northeast and has been a tremendous growth category for the dairy industry. It doesn't pack the same punch that cheese does simply because it's a much smaller segment than cheese sales are. But nevertheless, yogurt has been a growth category for many years for us. This particular chart here is showing you average daily yogurt production, which I'm equating, since it's a fairly a product that can deteriorate fairly quickly, is probably quite close to consumption. And you'll notice the increase. Now this is total yogurt. This is not Greek yogurt, or it's not separated from more conventional yogurt, but it's total yogurt sales on here. And one thing I think you might be interested in looking at a chart like this, and that would be to say, well, I kind of remember when Greek yogurt started grabbing a lot of headlines and attention. We've had a tremendous increase in those sales. But in this total yogurt graph, can you see where Greek yogurt actually came onto the scene? It's not obvious, really. And so I think that one of the things that's happened is that Greek yogurt has had a tremendous increase in production and consumption in this country, but it's also come at the cost of maybe some of our conventional yogurt. So we're still on that trend line out here, but it's come at the cost of more conventional yogurt sales. Not a bad thing for dairy, because Greek yogurt is taking a lot more dairy solids to produce. So from the standpoint of milk sales, it represents even more milk going into that category. This is also where we've had probably some of the category shift from fluid milk to yogurt. Many of you, perhaps listening on the webinar today, can attest to some of your own changes in behavior. I know that quite often I don't have a bowl of cold cereal with milk on it in the morning for breakfast, but will instead grab a container of yogurt. And so that's representing some loss of fluid sales in my own household and an increase in yogurt consumption, and we see a fair amount of that across the country. One thing I think to be pleased about, however, is if you look at all of our dairy products and you add all of them up and look at the per capita consumption in this domestic economy, you'll see here that it's been on an increasing trajectory or trend line for quite a few years. We did have a real jump there in the 80s. That was mostly due to cheese, but nevertheless, over this time period, we've been increasing, and that is certainly true for us the last year or two. So on a per capita basis, milk equivalent and domestic consumption has been really pretty good. That's the good news story as well. But I want to shift gears a little bit and recognize that domestic sales and our consumption here at home is not the only thing. You know, we've really heard a lot about this 9 billion people in the world that we're going to have to feed. And you'll notice this population, and I'm breaking this up by a few different regions of the world, and finally this blue line is the world line, is an almost unwavering trend. So it is not at all difficult to extract that line forward and just ask yourself, when does it cross the 9 billion mark? And of course, our demographers have said that that's going to be the case in about 2050. So world population is certainly growing. We look at this as a possibility for dairy products, but historically, dairy has been a product that worlds that have a certain amount of wealth are able to afford, and not countries that are simply growing a lot in population. So world population hasn't necessarily equated to better dairy sales. So let's take a look at some of the wealth out here. One measure is this gross domestic product, and it's the value of goods and services sold by regions, by countries, or aggregated on up to the world. And here you'll see that this last decade that we've had, since 2000 or so, has actually given pretty spectacular growth in world gross domestic product. You'll also notice, if you can focus down on some of the lines here, like the North American line, that while this has grown, and it did have this decline here shown in 2009 as our recession, you saw some of that in other regions as well, like East Asia. Here's a little flattening, but it was not a decline, and in fact their growth has been steeper than our own. So gross domestic product has shown that much of the world did not share in the recession that we had in 2009. But let's change this to a per capita gross domestic product number. And if you look at this, you'll see that North America, which includes Canada and the U.S., of course, has a tremendous, about $50,000 per head of gross domestic product. Very wealthy region of the world. You'll also notice that down here, the world line is well below North American line. And that makes it difficult for us to take a look at some of these. So I'm going to show you this same graph, but taking North America off of it. But recognize that the world has something like $10,000 per capita, while North America has $50,000 per capita. There's a vast difference in wealth across the world. So now I've taken the North American off of there, and you can see the scale shows some of these other regions much better. If you look at this last decade here, you'll look at some regions, for example, like Latin America and the Caribbean area, where we've gone from 2000 at a level of about $4,000 per capita to maybe close to $9,000 per capita. And you'll see that this is more than a doubling of wealth in this 10-year, 12-year time period. Tremendous growth in wealth. You'll also notice that regions like Europe and Central Asia, one of the reasons that Europe looks as bad here as it does, you'd think it would be closer to North America, is that it's also lumped in with countries like Bangladesh and India. They've had quite a rise in wealth. But I want you to focus on this red line here, which is East Asia and the Pacific. This is the area that includes China. And in fact, China as a country outperforms East Asia on this particular line. Now, their change in wealth over this same 10-year time period has gone from about $1,000 per capita in the year 2000 to more than $5,000 per capita. So they have had a 5 times increase in per capita wealth over this time period. This is faster growth or increase in wealth than any other region of the world, and it's really allowed them to do some pretty spectacular things. With that 5 times increase in per capita gross domestic product, East Asia can think about some things that they didn't think about before. One initially was we needed to be concerned about adequate calorie intake, and that's not true now. They've got plenty of calories to consume. What they want to do is to upgrade the quality of their diet with more animal proteins, and dairy is featuring prominently in that mix. Tom Hurdle's an ag economist at Purdue University, and he studies world food consumption. And Tom suggests that for the first time in history, it's actually not population. It's not getting to those 9 billion people that are driving increased demand for food. It's wealth of population that's driving increases in food consumption and changes in the type of diet that we have, which means that 5 times increase in per capita wealth in countries like China allows them to purchase dairy products and they've grown quite a bit. You'll notice here on the quarterly imports that China's been having on 3 different products: whole milk powder in the blue bars, whey powder in the red bars, and skim milk powder in the green bars, that their increases in imports have been not quite linear, but very close to it over this last 4 or 5 years. So they've been increasing rather tremendously. Whole milk powder is the largest category in most of the months and time periods, but followed very closely by whey powder, and skim milk powder then slightly below that. They are importing cheese as well, but not nearly as much. And these 3 powders are really protein sources. This is what a diet in China is looking for, and they're looking for animal proteins, and they're getting them through these 3 products. If you take a look at who is selling products to world market, these are in some sense the U.S., but also our competitors. The 27 countries of the European Union have historically been the largest selling countries of the world into world trade. But more recently, New Zealand has caught up with the EU. And the 2 of those regions, this tiny island of New Zealand and the 27 countries of the European Union, are exporting approximately the same volume. What's also extraordinary in this chart is that the U.S. shows up now as the number 3 dairy exporter in the world. We are somewhat behind the European Union and New Zealand, but we are a major exporter and well above Australia and indeed all other countries that are exporting dairy products. You'll also notice perhaps over here that in the last year or so we had a very large increase in our export numbers, and this came at the loss of market share, if you will, for New Zealand and to a lesser extent the European Union. Now, this wasn't just that we had products that the world wanted and prices that the world was willing to pay. This was that these 2 regions of the world struggled some with milk production. Weather makes a tremendous difference, and this last year both New Zealand and the European Union had problems. Both of them are much more pasture-based than we are, certainly New Zealand to a much greater extent than the European Union. But they started their production seasons off quite strong, but ended the last half of their seasons with real problems. For New Zealand, it was one of the worst droughts that they've seen in 30 years, and that caused a final decline in their production of about 6% milk production. The European Union had exactly the opposite problem. They had too much rain the second half of their production season, and they finished down about 1.2, 1.3% in milk production. So both of those exporting countries gave the U.S. some real opportunity to pick up world market share, and we did that. If you look at the U.S. trade in dairy products here, as a percentage of our own milk production, you'll notice that exports have been increasing since about 2003 or 4 as a percentage of milk production. We're now at the level of about 15.5% of our milk supply that's being exported. This is a big number, and it's important for us to recognize that with that much dedicated to export sales, we have to think about our competitors and our opportunities for sales outside the U.S. Because if we don't get those sales, as happened in 2009, then a lot of milk and dairy products get pushed back to our shores and can have very bad consequences for milk prices. You'll also notice on this chart, however, that imports into the U.S. have been declining as well. And that's been an interesting phenomenon that's happened. This has happened in part because the U.S. dollar is weaker than it used to be, but it also has happened because we're producing products that we used to import. Higher valued cheeses, for example, that used to come from Europe are now being made in this country, and so we simply are sourcing them domestically rather than importing the products. Let's start to shift to U.S. production of milk. We had a gap through February through June in our production reports not being provided by USDA. So we're lacking information there, but the red line shows you the 2013 average daily milk production per cow, and the other lines are showing you earlier years average daily milk production per cow. Seasonal component to this yet in our country for sure, but it's nowhere near as seasonal as it is in most countries. We've had increases in 2013 that are much smaller than would normally be the case. We simply didn't push very much milk per cow out, and I think in no small part because feed was really quite expensive during the year, and in some areas we had direct effects of pretty dry weather conditions and a shortage of forage in some regions. So milk production per cow, it did grow, but it grew at a very slow rate. If you look at the number of cows in the U.S. herd, this has been nothing to write home about. We experienced a few months in 2013, July, August, and September, when our cow numbers were somewhat above year earlier levels, but actually most of those months we've been below the number of cows. So cows in our herd have been staying fairly close to where they were the last couple of years. Certainly no real growth going on. We project that that might change, but it's happening at a slower rate than we've imagined. Put those two things together, we can look at what's happened to milk production. And there have been a few months, mostly 1 month, March, when we had a decline in milk production, but for the most part we've had modest increases. Those increases have been at a high of 2% in August, and most recently the last milk production report showed November with barely an increase over year earlier levels. So our milk production is increasing, but it's increasing slowly. What I think is fascinating is to take a look at regional differences in milk production. And this is looking at the actual change in pounds of milk produced per state, and this is for the first 3 quarters of 2012 and through 2013, or excuse me, the year 2013. So in other words, looking at these first 3 quarters during that time period. You'll notice that the biggest declines in milk production in actual pounds have been over here in California. California is suffering a 130-year drought, so they've had a very bad year in terms of dry weather conditions. They've experienced things like really relatively high feed costs and milk prices that are okay but not great. So they've had declines in milk production. It's also interesting to notice that there's a large regional pattern to this, that in general the West and South have been the regions that have had declines in milk production, while this northeastern quadrant of the country has had the increases in milk production. So regionally we've seen some differences in milk production. We've had a reprieve from the very high milk or feed prices of the last few years. In 2012 and 2013, you'll note that our value of the rations that the National Ag Statistics Service calculates had really been about $12 per 100 pounds of ration, a very high level from historic regions, and even higher than what we thought was a crisis of about $10 in 2008. But recently, since harvest time, we've had this decline in corn and soybean prices, and to a lesser extent, hay prices as well, to where we're now down again at these 2008 levels. So the feed values have dropped quite a bit, and that's providing some relief to dairy farmers right now, as are fairly strong milk prices. So let's take a look at the year ahead and form our projections. The U.S. Domestic economy has been improving. Modestly, not a great shakes. We keep expecting that we're going to have a breakout year, and perhaps 2014 will be that year. But there are a number of indicators that say we're still on track. From 2010 high of 10% unemployment, we've been whittling that down, and finally this last unemployment report, we are at 6.7% unemployment. So we've had an improvement there. This has important implications for consumers and the way they feel about the economy and their preparedness to spend money. We can also see this in the change in gross domestic product. Clearly the 2009 recession is showing up here, and this is the quarterly change The last full quarter that we had showed a 4.1% increase in our domestic GDP, but even the fourth quarter of 2013 is now projected to be above a 3% increase. So we're looking at fairly positive growth in the economy of this country. Two things, unemployment and GDP, that are looking like they're moving in a good direction. There's also a survey that's done by the Consumer Confidence Board about consumers' belief in the economy. They ask two sets of questions. One is about how are you feeling today about the economy? That's the present situation, and that's shown in the blue line. And the other is, what do you think the economy is going to look like or feel like in about 6 months from now? And that's the green line. What's usually reported, and that we always talk about, is the red line, the consumer confidence, which is a combination of those two items, present and future expectations. Now you'll notice that going into our recession in 2009, where all of those economy confidence numbers were at very low levels, prior to that, we had consumers that were showing in their present situation, the blue line, that, yeah, actually the economy is pretty good. I like it today. But if you look at their expectations, they're saying, but I'm worried about the future. And this was well before the recession. Well, of course, we know the recession happened. After we got through the bottom of the recession, we now have expectations saying, I think the future is going to look much better, but it's really not very good yet today. These numbers have been pulling together and moving generally upward. But we've had a few months out here now where we've had a couple times that these present situations and the expectations have crossed. In other words, we're expecting things that aren't as good as what we're seeing. So consumer confidence is in the questionable territory, but moving in the right direction. For demand. I expect our domestic demand to be all right. And by all right, I mean modest growth, probably nothing special. The economy is growing, but consumers seem reluctant to be burning out and spending lots of dollars just yet. I think that our export demand is going to expand, but probably not at the same rate as last year. And the reason is that New Zealand and the European Union have much improved weather production this year, and they look like they're on track for a much better harvest of milk and sales into export markets. But China's demand for dairy products is still growing, as is the case in other parts of the world. North Africa and the Middle East are areas where we export a fair amount of dairy product as well, and that demand has been strong too. But we may see some price decline on dairy products, in no small part because of the expanded production from the New Zealand and European Union into world markets. So that additional product on the market could give us a slight price decline. U.S. product prices, however, are in a competitive position, and I think we'll sell dairy products into that marketplace. This is a graph that's showing you, or three graphs actually, showing you different products. This one in the upper left is non-fat dry milk and skim milk prices. The red line is the NAS, or actually now it's the AMS price for dairy products. And it is also being compared to the Oceania high and low range for those same product prices. And the same is true for butter and cheese prices. Now, it's typical for the U.S. to experience prices that are lower than world prices. We're selling our products normally at a discount. But last year, if you'll just take a look at the butter prices or even the cheese prices, you'll notice that our price was well above world prices. And this actually reined U.S. prices back in rather quickly. So right now, our prices are in good relationship to world prices for continued sales, and I don't think we have to worry about any lulls in that for the months ahead. Input costs. Feed prices are much lower in the coming year. We've already got the harvest in the bin, and so we're expecting that to be the case. Interest rates is one of the question marks I have. They remain low, at historically low levels out here. Can they get any lower? I doubt it. And I wonder for some producers if it might be time to think about locking in term loan rates for some of the lower variable rates that they've had. if there's the possibility of those interest rates beginning to creep up, particularly as tapering starts to happen with the Fed not pouring as much money into the money supply. Even though I expect milk prices to soften, the margins for producers are going to remain strong. And I'll show you that graph in just a second. We also would anticipate, it's always been the case, that when we get to real profitable years and time periods, it will stimulate capital investments to produce more milk. That, after all, is what a real profitable margin situation is telling a market, is that we want more of that product. So I expect that we'll see that. If you take a look at the Dairy Security Act's version of a milk feed margin, you'll notice that we are now in this territory where we're well above the middle third of observations over the last decade or so, and in fact we're moving into what would be the top 10% of margins of all time. So this is going to be a very good year for dairy producers, and I expect that this is going to continue through the entire year. That will be in the very positive category out here, although the margins do begin to erode. So if I take a look at projections for both Class 3 and 4 prices, those are going to continue to be strong, and in fact the futures market is projecting that we've still got room to move up in those futures market prices over the next couple of months. But one thing that has been unusual for us is that we've had a gap between Class 3 and 4, with Class 4 in the lead. Now typically when we've had a gap between these two prices, it's been Class 3 in the lead, but right now the dairy product prices are showing such strong export opportunities for butter and for non-fat dry milk that our Class 4 prices are really strong. And normally this would say that we would expect those prices to begin to close and move together a little more quickly. That's happening already to some degree, and at the kind of Class 4 prices, powder prices we have, many cheese plants are finding it not profitable to standardize their vats with powder, and so they're buying more milk and using raw ingredients to standardize the vats. That also is helping to pull up Class 3 prices, because that's being charged as a Class 3 cost. So my price forecast, I'm anticipating that Class 3 will be down about 70 cents, that Class 4 will be down somewhat less than that. I think that the Northeast all milk price will be down about 80 cents a hundredweight, and the reason that that's a little bigger than the class prices is that I think there'll be some room for erosion of premiums if we get enough milk being produced in the second half of the year. But I would go ahead and say that it will be a much improved milk feed margin. So there are some uncertainties. The domestic economy is one of them. Not all of the indicators that we have are pointing in the same direction, but in general I would say it's a fairly positive direction that they are pointing. So I think that the economy is going to be good, but you know, there's a possibility we could see some erosion, particularly if the Middle East continues to fall into crisis, or if some of the sovereign debt problems in Europe come to fruition, although those things look like there are lower probabilities right now. Export sales is an uncertainty for me, but in a positive direction. I think that if anything, they've got the possibility of being even stronger than I'm forecasting and would help to support prices. And the Farm Bill, finally. We have a dairy program that, will we have, I guess, a dairy program that looks like either the Senate or House version, or might we have an extension of the Farm Bill? This has some potential for a greater impact on individual producers than any real regions. So if I give you some kind of Farm Bill prognostications, I think there are 4 options out there. We could have what the Senate has, which is the Dairy Security Act, which includes this stabilization component. We might have just a margin insurance without stabilization. That's a bit more like the House had passed. We could have something like the MILC program. There certainly has been talk in some quarters of Washington about that. That would be the same old program, but would increase the production cap to maybe 4 million pounds. If everything fails, we would probably have an extension of our previous farm bill. But it looks as though we may have actually been reaching a compromise in the House and Senate right now, and that perhaps we will have a farm bill passed before the end of July or of January. If that's the case, what looks like the compromise might be a margin insurance, which doesn't include stabilization. They might try to be a little bit penal about overproduction during time periods of low margins by reducing the indemnity payment for people who are producing over their production base. And it could include some kind of provision for market purchases of dairy products. This is speculation. It's whisperings that have been heard in Washington, but I've never talked with anybody who actually has seen the actual language of what's been proposed in the compromise. But it looks as though we might actually have a compromise and an end to a farm bill, which in my opinion would be a good thing. At this point, I don't know, Chris, if we have some time, but I would entertain a question or two if you've got some.
Okay, good morning, Mark. Jim Putnam here with Farm Credit East as well. I really appreciate that great overview of what we might expect in dairy for this year. I think what we're going to do is we've got a reaction panel, and I'm going to ask Christy to open up the phone lines with them so that they're all live with us. We're going to get some reaction to what we just discussed from them in a moment. And then I've got at least one text chat question here, but encourage everybody else on the phone line to text their questions in, and we'll deal with those in a few minutes if that's okay.
Sounds great.
Okay, I would like to pick up on one point. This is going to sound maybe self-serving, but appreciate your comments about the interest rate outlook. I don't think any of us here could have said it any better. And for all of the folks who borrow from us that are on the conversation this morning, you know, we do encourage you to be talking to your loan officer about our fixed rate options. We have good both fixed and variable rate options. We're not going to make that decision for you, but we want you to be informed and understand at any given time what those rates might be. No question, variable rate options been a fun ride for the last 5 or 6 years, but things will change at some point. We kid about it, but if you're expecting a phone call from us telling you how to market time this thing, we can't do that. So just be aware of what your options are, but your loan officer would love to be able to discuss what the fixed rate options might be for, you know, some or all of your debt. So with that, let's go to the reaction panel. And I'm just going to, by way of doing a sound check, but also welcoming everybody, go right across the board here. So good morning, Mark. Are you out there?
I'm out here, Jim. Good morning.
All right. Stu, good morning.
Good morning. I'm sitting right next to Mark here.
Oh, you're in good company then. Keep an eye on Mapstone that he doesn't say anything too extreme here.
Okay.
And Rick, good morning.
Good morning, Jim.
And Jody.
Good morning.
Good morning and welcome. Thank you all. Well, I think I'm going to start off with Stu, and I'm going to bundle some questions here. But Stu, if you could give us a brief overview of your operation, and then maybe one or two things that Mark spoke about that maybe stood out to you. If you would lead us off, and we'll go to Jody next.
Okay. Thanks for the opportunity. We farm here in the hills and valleys of Cortland County. In 2013, we did something a little unusual. We merged with a neighboring farm. So we created a new entity. There's 6 active partners and 1 limited partner involved in this. And we farm now, we milk about 1,050 cows,
about 950 replacement heifers. Farm about 2,200 acres, of which half is corn and the rest are hay crops and pasture. I thought Mark's presentation was excellent and as usual, and was particularly I thought he was excited about the way he put the world demand market in perspective and the growth rates and wealth of the various sectors of the world. The one that was a little surprising to me was Latin America, I think, is how they have come up. The other thing, I guess it's hard to know, you talked about fixing interest rates, and that another consideration is when to fix the milk price. And that's something we're I'm grappling with. We've tried some in the past and usually ended up on the negative side, but it seems like there's opportunity right nearby now to do something like that with positive results.
Well,
Comments to maybe ask Mark to respond back as to what you think the opportunities might be to lock in some margin right now.
Well, Stuart, I'm a little like Jim, I guess. I get very nervous about making specific suggestions to people. But I will say, if you look at these margins, and we're in some kind of very unusual territory, places that we haven't seen before. It's going to be a great year for producers. And I also gave you an indication that I think that if I have big error in my forecasts, it could be that I don't have enough optimism in there. And if that's the case, then maybe you want to think about something like, putting a floor under a milk price, or for the feed costs that you are exposed to, that you're purchasing, maybe you want to put a ceiling on some of those. But, as far as the world food or coarse grain supply is concerned, much of the rest of the world is finding almost burdensome supplies right now. So I think that those might even fall further than we're seeing now or expecting. So it could be a good year. I'm not sure you want to go out there and lock in hard values for yourself, because I think there is some upside potential to improved margins from even the forecast that I've given you.
Okay, good response. Appreciate that. Let's go to Jody, and then Mark, you'll be up next.
Okay, I'm Jody from Orleans Poverty Hill Farms in Albion. We milk about 550 cows, 3X. We farm about 1,000 acres, and I'm part of the third generation of the farm right now. We sit in a very heavy cash crop area that's immediately around us, a little bit of fruit, but depending on what crowd I'm in, I can say I'm the largest or the smallest dairy farm in the town and be accurate with both. So we're part of the Upstate Niagara Co-op too. 2013 was a good year for us, production-wise, volume and components. Crop yields were average or above. Moving forward, I think it's going to be costly for us for gaining more acreage. Hopefully, with the turnaround in the grain market, or the change in the grain market, we'll be able to pick up some and improve in that area. But our big things next year, we want to work on a little better internal efficiencies. I think we got some room to improve on tracking crop costs and labor efficiencies, but especially to take advantage of some of these margins that are appearing. My response to Mark's presentation, I really think as dairy farmers in the past, a lot of us have taken it for granted, as far as marketing through the co-op, and I think with the changes in world marketing, we really need to stay active in our marketing, however it is, through a co-op, which in our case it is, and play an active role there. So that's about it.
Okay, thank you, Jody. Great feedback from you, and You are in a very diverse agricultural area there in Orleans County. Mark, why don't you introduce what you do? Not your operation, but what type of consulting you do, and maybe one or two observations about some things that you saw in 2013, and then some reaction to what Mark has just discussed with us. The other Mark.
Okay. All right. So Jim, I'm a business consultant with Farm Credit East. I work mainly out of central New York, northern New York, a little bit of eastern and western. I've been with Farm Credit about 12 years, and I primarily work with dairies. I work with farms from 50 cows to 5,000 cows, and probably I would say my average dairy is about 700 cows in size. And what I saw, in 2013, most of my producers had a pretty good year, despite, high input costs, feed, fertilizer, and things like that being up. The farms that had the best years didn't get affected by the forage issue and the drought that we had in 2012. Most of them were able to show a pretty good profit in 2013, rebuild forages, and pay down some debt in general. I think the most common situation I see out there is most farms are pretty much at capacity, running at capacity, and what we did is we focused on doing better with what we had in 2013, especially production efficiency. We worked on income over feed costs, the things that affect that, reproduction, feeding, cow comfort and cooling. A lot of folks invested in that this past year with some good results. So despite high input costs, we had enough milk price, and they were able to improve their production efficiency enough where they had pretty good years. I was surprised a little bit at Mark's projection for milk price for 2014. If you looked at the futures market right now and figured the same basis as last year, milk prices right now will be up about $1 from 2013 levels. But I know from experience, that export market can really swing that price very quickly, and other factors. I guess when I'm using in my budgets right now, we've been trying to be a little conservative and use about the same milk prices as 2013 on most of my clients, unless there's a special circumstance with improved components or something like that. But I think what I really took from his presentation the most is how we really rely on exports a lot for our milk prices, and I don't think we really can count on that, being every year growth and every year increase in demand in exports, how quickly it can change like 2009 did. So that's kind of my biggest reaction to that. As far as 2014 with my clients, we're going to continue working on production efficiency, even with milk, with feed prices being down on most of my farms. It's, in other words, doing better versus getting bigger, but I've got several folks that are in the process of looking at barns and have some confidence that they're going to try to take advantage, position themselves, with a little bigger herd and doing what they can there. But I think probably the bigger issue is we're trying to really work on setting folks up, rebuilding liquidity, paying down debt, positioning ourselves for that next downturn that we know is going to come someday.
All right, thank you, Mark. I'm going to ask Mark Stephenson, want to do a rebuttal on your milk price forecast, I guess. I think Mark Mapstone indicated that maybe futures are saying higher milk price. You're saying a little bit lower. Just want to kind of reconcile, regroup on that forecast, please.
No, I'd be happy to. I don't think it's that far out of alignment. For one thing, I'm not looking at a horribly depressed milk price, and in fact, in the first 6 months of 2014, I am anticipating a bigger milk price than we had the year before. But usually we're our own worst enemies, because that kind of price and profit usually is providing a strong enough incentive and wherewithal for producers to increase milk production. they've been a little bit slower at doing that this time around, and I understand some problems. Northeast had a pretty wet year last year, and some of the forages, I think, are just not letting milk per cow come through like it has in the past. So that's one issue. Maybe we lost a few heifers out of the pipeline because of high feed price or high meat prices. The market for beef has been very, very strong, and we do know that some of those animals didn't go to a dairy herd but rather to a finishing operation. But I think farmers will find a way, and we'll produce more milk, and at some point in time we'll find that downward pressure on prices. But even given that, yeah, cheese right now on spot market is north of $2.20 a pound. Butter is north of $1.80, and non-fat dry milk north of $2.05. I mean, these are really incredible prices. So enjoy it, but prepare. I might also say that, you know, Mark made a couple good comments about what are you going to do with these profits. Think about that. Are you going to invest in more productive assets, or are you going to try to put your balance sheet in a better position for the next downturn? We'll clearly have some time to do it this year. We've got, in fact, probably 12 months to think about doing that. So producers ought to.
Okay, thanks for the response. On this particular question, and then we'll go back around on the next question, but Rick, wrap us up. Tell us a little bit about your consulting practice and where you operate, and then maybe a couple of observations from 2013 experience.
Well, good morning. I'm Rick Hermanot. I work as a business consultant out of Dayville, Connecticut, but I serve all of New England, so I'm in all 6 New England states, working with primarily dairy, but also a bunch of ag retail businesses. 2013, with my clients throughout New England, I found to be a better than average year. Milk prices were about $1.50 or so higher than the 5-year average, so better than average. Net margins so far are looking to be somewhere in the neighborhood of $2 is pretty typical from what I've seen so far. $2 a hundredweight, whereas the 5-year average is $1.40. So in the Northeast, so a pretty good year. Forage-wise, yields were about average. Quality, though, I'm hearing is a little off. Digestibility a little off. That wet late spring, late May, early June got real wet, and everyone had to top dress, and it stunted the crop a little bit, and that seems to have affected maybe quality a little bit. But but otherwise, a good year for 2013. In terms of what's coming, it's pretty exciting to see that we probably are looking at a pretty darn good year for 2014. Most of the guys I work with are not focused on expansion right now. They're really focused on building their balance sheet. I really think that there is a downturn coming, and everyone needs to be ready for that. So we're heading through this good opportunity to build liquidity, either through building some savings and paying some taxes, or paying down debt, or maybe looking at prepaying going into the next year. But building their balance sheet, I think, is the priority for 2014. I haven't got a lot of guys looking at any significant expansion in New England. The other big focus in a year like 2014 is to stay focused on cost control. Pretty easy to lose that focus when the margins are pretty good. But those guys that stay focused on that and really can cash in pretty well in a year like we're hoping to see coming up. In terms of Mark's presentation, I really enjoyed it. It's good to see an overview of what's going on in the world market, since the export market is really driving our market, our price. I would agree with Mark. I've been thinking a little bit stronger in terms of the outlook for 2014. I wasn't sure if Mark's outlook was based on 80 cents down from the current price or 80 cents down from the 2013 overall average price. But I've been doing similar to Mark, budgeting kind of similar prices to last year for 2014 in budget.
Okay, thanks, Rick. Mark Stephenson, you want to respond to that? Your price forecast is based off of the 2013 average annual, or is it based on December?
No, it's based off of the 2013 average annual. I found that most people relate better to the kind of change that they've seen from previous year, because everybody's farm price differs as a result of components or your opportunity in the federal order and blend prices. So I provide that kind of a difference to use in your own personal budgeting.
Okay, well, great responses and kind of give and take first time around. So I want to go back through the batting order and maybe one or two lessons learned from 2013, something that you kind of got driven home to you in 2013 that will guide some decision making, some advice going forward. So Stu, any lessons learned from what went on in 2013 that will help you going forward?
I guess the merger was for us quite an experience, and I should say that Mark helped guide us through that. He did an excellent job. We realized efficiencies from that, and that was kind of the fun part, to see what some of them were we anticipated, some of them were surprises, and we hope to use that experience and continue to find efficiencies from our larger size and scale that we think will help us be viable into the future. Another thing we did, we toyed with cover crops before. We planted some triticale, and a cover crop through the winter. It was 2012 was a tough year for forage quantities. It was an excellent year for forage quality, but we were glad we did that. We harvested triticale. It made an excellent feed stuff that we harvested in May. There were some challenges with it that we're going to have to learn from if we use cover crops in the future, which I think we will to some extent. But it was a learning. We went through some learning curve on that.
Great comments, Stu. A little bit of a parallel. Farm Credit East also went through a merger last year, and now combined with Farm Credit of Maine, and maybe the fun part of a merger is putting it together, but the hard work part of it is making the efficiency gains and achieving everything that your plan said you wanted to out of that. So kind of an interesting comment there, and we're all still learning a little bit about the agronomy of what our soil resources will enable us to do out there. I thought your comment about triticale was interesting. So Jody, a couple of lessons learned on Poverty Hill Farm here in 2013.
A lot of ours is, we've learned it's going to be difficult to acquire more land. It's going to be expensive. Along the same lines as Stuart, we're looking at different things to do with the cropping. We haven't done as much as far as cover cropping, but we've toyed with a little bit of different equipment for this upcoming year, and we'd like to do similar to what he's talking about with some of the other crops, with triticale and that. One of the big things I would say in the past year and a half for us that's been kind of eye-opening is we made some major changes to how we raise calves and switched to a group housing barn instead of hutches, and just in tracking the numbers in that, it's been real eye-opening for us to see the kind of savings that we can do just by improving labor efficiencies, and really how we need to analyze the different enterprises of our farm and fine-tune where we can to take full advantage of these margins that are showing for this year.
Thanks. Again, the state of the art continues to evolve, doesn't it, on things like calf raising and balancing your different enterprises and so forth. I do wonder whether the the dynamic on land values is going to shift a little bit here in the next couple of years with the bloom off the rose on corn. But like interest rates, all we can do is kind of speculate about what the real estate market might look like. So appreciate your comments there. Mark, you kind of got into that a little bit before, but a couple of lessons learned that you want to remind our listeners that might help them plan for 2014 and beyond.
Well, I think, Jim, one of the big lessons learned from 13 was the impact of not having forage carryover, from the drought, and really, I'd say a real refocus on crop management in general. I think that's something that, we know a lot about each dairy cow, and some farms have daily weights where we can tell just about anything every day about the cows. But the forages, we're in the forage production and grain production, we really got a lot of lacking there in terms of management capability. The other thing I think was important was, the importance of milking the right cows and working on that production efficiency. Looking to see, if a cow's not making you money, maybe re-looking at your culling strategies and things like that, but really also being focused on herd health, cow comfort, reproduction, the things that really help us achieve high production in the herd. I'd say that's probably what I would say on that question.
Okay, very good. Some plenty of homework there. Rick, wrap us up on this question, and just for the benefit of the other panelists, I'm going to go through one more time with kind of a 1-minute wrap-up. Anything else you'd like to talk about to kind of close off this part of the session? The four of you have done a great job of giving us some good, useful information and insight into what Mark Stephenson presented to us a few minutes ago. But so, Rick, if you would wrap us up on the lessons learned, and then we'll go back to Stu on the 1-minute wrap-up.
Okay, well, with the really high input costs, feed and crop costs, fertilizer costs in 2013, it was a year where I really thought a big lesson was a focus on efficiency was a big one. Balancing heifer inventories and culling strategies, culling the right cows and maybe culling more proactively, keeping cows bred, those guys who did that really well, getting cows bred back well, really that affected the production efficiency and made for a better year. Maximizing forage quality, the guys who really focus on that with high feed costs, the more you can get out of your forage, that can pay big dividends. So kind of similar to what Mark said, a focus on efficiency, production efficiency, getting the most out of your forage and keeping the right cows around, and those were some pretty good lessons I think that will carry forward as well.
Okay, very good. I can't help but observe when you look at Mark's graphs and what's happened in the export market in the for the United States in the last 10 years is, I think, pretty phenomenal. I'm not sure anybody forecast that, Mark. Maybe you want to take credit and say, yeah, I said that was going to happen. But it's been a pretty neat ride. But I can't help but believe that a lot of that is based on the efficiency that has occurred in the U.S. dairy industry over the years that has enabled us to get in there and be very competitive in the world market as these windows have kind of opened up. So all of this kind of ties together in a nice package for the Northeast dairy industry. Let's go back through our batting order, kind of a 1-minute close. No question. You can say anything you want. Any other observations or perhaps a question left unanswered or something like that? But Stu, wrap us up 1 minute.
Okay. I was asking for a strategy for 2014, so I made a couple notes on that. I think we want to continue to improve our productivity, both in the cattle and the crops, and reduce the cost of production as much as we possibly can to make the best use of the margins that we anticipate. So we did some, as part of this merger, we did some building this year, and I think we're continue to kind of grow into those buildings and make the best use of them, learn how to make the best use of them, and look forward to a good year this year.
Thanks for being with us today, Stu, and really appreciate you sharing your insights here. Let's go to Jody.
We look forward to this year we're probably going to do a little bit of building to improve some efficiencies in our heifer side and eliminate some overcrowding. But also one thing I haven't really said much about is we participate heavily into the benchmarking, and so we look forward to getting that done and underway and using those numbers to move forward and hopefully do some better tracking like I spoke of earlier. But that's pretty optimistic about this year.
Well, that's what we like here. Thanks, Jody, and our best to you and your family. You guys have a great operation out there. Mark, your wrap-up.
Well, I think if we focus on the big picture, I've always been a believer in what you do with your earnings and your cash flow on a good year. It has a lot more impact in your operation than trying to worry about it during a tight year. So this year coming up, looking really profitable for most of our dairies. Using the funds wisely in terms of building liquidity, paying down operating debts, building cash reserves, setting ourselves up maybe with a lot of prepaids and things for the going into the following year, which we're kind of uncertain as to where we're going to be in milk price. I'd say that to me would be, a good summary of a focus here for 14.
Very good. Really appreciate your insight and all the work you do with dairy farms. I think by the time you described your practice, you were pretty much all over New York State, Mark. Even though I know you have pockets where you do more business than other, but really appreciate it. And Rick, you get the last word, which sometimes is the best spot to be in, but sometimes it's the toughest to tease out something new. So go ahead.
Yeah, exactly. It's tough to come up with something new after all that stuff. I would echo a lot of what Mark said. I really do believe that we're heading into a good year. It's very important to focus on building your balance sheet, building liquidity, preparing for a downturn. Everyone says, oh, God, we'll never see another 09. Well, maybe not quite as bad, but maybe we will. And I think we all need to be prepared for something like that to happen. We've had a pretty good positive run in the dairy business, and so there's going to be a pretty big downturn coming at some point. And I'm a little bit concerned that 2015 could be that. So I've been talking to my clients about focusing on building a balance sheet, building liquidity, things like that. So kind of echoing what Mark said.
Very good, and appreciate the work that you do around New England, and as many of you probably detected from both Mark and Rick, while we have tremendous respect for the work that they do in the dairy industry, they also both consult with other types of agriculture, and while some of the a lot of the technology and the practices may be different, I think it gives them great insight into farm businesses in general, because they do go well beyond dairy businesses. So thanks, everybody. We've got a lot of questions for Mark Stephenson here. So Mark, you had a chance to kind of catch your breath a little bit here, but I'm going to go right into some of the text chat questions, and we've got 10 or so minutes here, and ask that we kind of keep the answers fairly crisp, so we can get around to a lot of these. I'm not going to take them in order. I'm going to kind of take some ones that I would like to get to as a matter of priority. So first question, how long will it take for record high milk prices to impact domestic demand? Great question.
Well, we've seen that consumers, we used to think that some of these numbers were magic numbers. For example, you can't be above $2 a pound on cheese for more than a month or so because consumers are going to push back. And, you know, they will at some point, but I think the general inflation has gotten us to the place where the kind of prices we're seeing are not terribly off-putting to consumers yet. They feel sort of normal. So I don't think that we've got prices that we're looking at this year ahead that are going to be a real damper on domestic demand.
Okay, next one. Wondering about infant formula in China. Is the demand for this product shown in your product graphs? Any idea of how much of U.S. production is going into infant formula?
Good question. We do have a fair amount of product that's going into infant formula, but I think you would recognize that that's still a fairly small product in overall movements of sales overseas. But it's an important one. It's a high-valued product, and it is something that we're selling into countries like China in particular. Real concerns there over quality and safety of their own milk supply, and indeed from other countries. The U.S. Looks very good, and so particularly for things like infant formula, we've had some real sales opportunities. I can't give you the numbers without looking at them off the top of my head, but you know they're small relative to the other volumes.
Okay, next one may be a little bit along the same lines, and I'm going to ask you to just kind of give a little bit of background to what the inference is to. Question is, can you comment on the recent news regarding Fonterra and what impact, if any, this will have on U.S. producers?
Okay, I take it by that you mean the problems that they had with product quality and product safety. And yeah, I mean, this is a black eye for Fonterra, and they've recovered, I think, reasonably well. They stepped up and owned the problem and have indicated that, you know, they want to pull all that they can find off the markets and move ahead with that. They're excellent quality producers and processor. So I don't think this is going to be a big problem for them long term, but it was certainly something that surprised a lot of people. And that product shouldn't have gotten out into their mainstream of ingredients.
Okay, Mark, do you think eventually we'll gravitate domestic milk pricing policy to more of a world marketplace discovery price? Isn't that happening now more and more due to export?
Oh, it's absolutely a good question or comment. And yes, I mean, I think I made mention, but if I didn't, it certainly is true that what happens overseas impacts us, both in the demand side for products, but also in terms of what our competitors are doing. So we are tied to world prices as it is, and perhaps we ought to incorporate that a little more directly, but we're doing it indirectly still through our product price formulas, and those product prices are moving in accordance to what they can sell domestically and what they can sell overseas. So we are tied together already, but maybe we ought to have, at some point in time, a more direct sales opportunity value in the product price formula.
Okay, next one, Mark, give you a chance to editorialize a little bit. It seems that many perceive dairy products as unhealthy or fatty. The problem is not milk, it's the push of sugary beverages and the increased consumption of those products. What can be done to influence the public perception toward dairy products, including fluid milk?
Oh, tough question. You know, the fluid milk problem that we've seen has been with us and on the table for many years, and we've attacked that at a lot of different, from a lot of different angles. We clearly have consumers who have, I guess, kind of, quote, climbed down the fat ladder in what they're purchasing in the way of beverage milks, from whole milk to 2% to 1% to skims. But, you know, the curiosity to me is that we're not producing any less butter fat than we ever did, and we aren't throwing it away. And in fact, butter itself as a product has received the blessing, I guess, of dietitians in that it's now a good fat. Once thought to be a bad fat, now thought to be a good fat. And so butter sales are up. Cream sales have been up. We're consuming all the butter fat we're producing. I think that we have to maybe forget about selling dairy products as readily identifiable dairy products and more just recognize that we're selling high-quality nutrition, excellent flavor as ingredients in a lot of other foods. I mean, if I were a dairy producer, I really want to sell milk, and I'm not sure that I care too much how it's delivered to consumers.
Okay, a number of you have texted in asking about the availability of the material from today's presentation, and Chris Lawton is going to cover that at the very end of the webinar, but the answer is yes, it will be available, and he will both announce that, and it will be posted on our website, www.farmcrediteast.com. So that answers a number of questions. Going to go back through the list here for some more really interesting questions. Regarding cheese consumption, is there a breakout for specialty or boutique cheeses?
In terms of the sales numbers, the answer to that is yes. If you look at Dairy Products, which is a publication from National Ag Statistics Service, there are monthly values for many different kinds of cheeses, and you can see what sort of cheeses have been moving. It's clear that we've had some movement away from our big sellers, which has been cheddar and mozzarella cheese in the past several years, and a lot more sales of what we typically will lump together and call other cheese, and that is specialty cheese products. Lots of different blue cheeses and Edams and Goudas and just a variety of dairy products. So our palate, our taste and sophistication for cheese has clearly changed and continues to evolve.
Okay, next question. Looking through here, I've got some more. I'm just, I haven't been going in order. So, question, what do you think is holding back milk production from increasing, faster than it actually has been, Mark?
Yeah, that's a good question. And, I've got maybe 2 or 3 hypotheses. One of them is that some places are experiencing a bit of digestibility problems with forages. Northeast is really clearly there. A wet year usually gives us some digestibility problems, and in the yield per cow numbers that you see on those states, that seems to be revealing some of that. So that would be one thing. I don't think we've had as many replacement animals in the pipeline right now as we've had in the past couple or 3 years. So that's another. And final thing, I think the third thing is that people have gotten more cautious. It's a great time, I think, if you can afford to do it, to increase your capacity or farm size when we're at one of these lows or poor times for margins. Not only can you oftentimes purchase the construction and animals and things that you're going to need at a lower cost and price, but your barn is full and you're up to capacity and ready to go at just about the time we have these great margins. So, sometimes we should be getting counter-cyclical. And I think people have gotten a little bit more concerned about when they make the jump into expansions, and that's where we are right now. So those would be the 3 things I think about.
Mark, I had myself on mute. Next to the last question, how will the increase in Class 4 milk products powder affect our price for milk with our present pricing formulas?
Oh, I'm sorry, Jim. Could you give me the question one more time?
Yep. Nope. I had myself on mute, so you didn't hear me the first time. Let me go a little bit slower. How will the increase in Class 4 milk products powder affect our price for milk with our present pricing formulas?
Okay. Well, first of all, I think it's important to recognize that for the Class 1 sales, we are using the higher of the value of Class 3 or Class 4. So Class 4 is going to be driving the skim milk value in Class 1 sales. Of course, you recognize that the Class 2 growth that you've had there in the Northeast is also really based on the same formulas that we have use for in terms of the non-fat solids in milk that are based off of Class 4 prices as well. So the Northeast is in position, even though you don't have a lot of Class 4 sales directly, you are being influenced by those Class 4 prices in a fairly positive way. The upper Midwest here where I am, of course, doesn't have so much of Class 1 or 2 sales and not so much Class 4 sales. So this region is not getting the same benefit of these high Class 4 prices.
Okay, I told you that was the next to the last. I'm going to come back in just a minute here, Mark, and just give you 1 or 2 minutes for wrap-up. You've done a great job here, as usual, this morning, shared a lot of information and perspective with us, and really appreciate that. But I'm going to take you off the hot seat and answer one of the questions that I suspect you would not have really cared to want to answer, and the question is to the effect of how have debt per cow levels, acceptable debt per cow levels, changed over the last few years? And I suspect that's maybe better answered by somebody from Farm Credit. And if I had one of my credit folks here on the line, I would turn it over to them. But let me give a kind of a general answer to that. I know there's common perception out there that there must be some secret number that we keep to ourselves here, that if you're above this level for debt per cow, that's bad. And if you're below that number, that's good. And it really doesn't work that way. First of all, we approach credit analysis on a farm-by-farm basis. And because it's a complex set of arithmetic, and it's not just one number. It's the interaction of certainly a handful of numbers that go into, what is a comfortable debt per cow for both the producer and the lender in a particular farm operation. I would tell you that we have farms where $1,000 debt per cow is plenty, and we have farms that can handle north of $4,000 debt per cow, at least for some period of time, and that might be comfortable. So it's really dependent on the circumstances of that farm, and especially their ability to generate earnings. That's the big driver in all of this. It's not the only one, but if you look at the profitability of that farm over a period of time, that's going to have a lot more to say about acceptable level of debt per cow than anything else. The second thing, and I kind of inferred this a moment ago, is, we've come to look at that number as, it may be variable over time. So it's not a particular line in the sand. So a couple of examples. At the end of 2009, our dairy customers all had substantially increased their debt per cow. That was what it took that year to get folks through the downturn. Now, and we didn't lose any sleep over that. That was by design. We knew as the crisis developed that that's what it was going to take, and we were prepared to extend the necessary credit to keep good producers going. And but we also recognized that as we got into 10 and 11, that those debt per cow levels needed to get brought back down to be prepared for the next period of adversity. Likewise, when we take a business through a major expansion, we see those debt per cow levels spike up. We know that's going to happen, and then we look to see that come down in a disciplined sort of way to a more normal level. So summarizing, no magic number on debt per cow. If you look at our annual dairy farm summary, it has drifted up in the last 5 years. But if you look at the same study, you'll see that there's a wide range among individual producers, and that's really why we do credit analysis farm by farm, not on a some formula that comes out of national headquarters in Omaha or Chicago or maybe even Holland. We do it farm by farm in each of our branch offices. So, Mark, now that I took you off, and you're welcome to chime in on that question if you wish, but if you would give us a wrap-up and we'll let you relax.
Well, I think that, as I mentioned in the talk, this is going to be a good year for producers. And I know that being traditionally conservative regions of the country, the Northeast is going to think about how do we use this good year and restore balance sheets, maybe invest in some productive assets, do a few other things quite well. But the other thing that is almost surely going to come across for producers shortly will be the end of a farm bill process, a long process. And my guess is that individual producers are going to have some real decisions to make about participating in a program that might be very different than what we've had in the past. If that's the case, think about it pretty carefully on a case-by-case basis, because it's unlikely that it will be just everybody should do this kind of recommendation. I will tell you that I'm working with a group of economists from around the country, and we're building a decision tool that should help producers think about their impacts of whatever's passed for us on their own operation. So you'll have plenty of decisions to make in a good year.
And again, Mark, thank you so much. You certainly have a tremendous breadth of knowledge about this industry, and a great way of sharing it in I'm going to say non-academic terms, so that the rest of us can understand and apply it in our own businesses. So thanks for being with us this morning.
You're very welcome.
We're going to go to our next speaker. Another one of our very good friends here in the Northeast dairy industry. I think a kind of a unique resource. If you look at his professional background on the screen, we don't have too many people around who are both experts in the dairy industry, have a law degree, and love being involved in all this environmental regulation stuff. Think about that. That's certainly a unique combination. Individual who grew up in the New York dairy industry, still has family, I think, on both sides. Both he and his wife have family out there in production. And we've had Karl with us for a number of years on this particular webinar, and we always learn something useful from him. So I'm going to turn the microphone over to Karl Czymmek. Thank you.
Good morning, everyone. Thank you. It's a pleasure to be here. I just want to double check. Can you all see my screen now?
We can, Mark, or Karl.
Yes, good morning. Well, again, thanks for that fine introduction, Jim, and without further ado, I'll launch into just some of my thoughts and some issues on the environmental side, and also spend a few moments on an OSHA update, the OSHA inspection issue that we saw surface here in the last few months of 2013. So we'll start out with one of the bigger topics, CAFO, with a focus on New York State. Most people know by now that it is indeed official. New York CAFO permits are now required for operations with more than 300 cows, and it is somewhat optional for farms between 200 and 299 cows, and that would be for farms that do not discharge. They do not need a permit, and in fact they can file a notice of termination if they have been in a permit situation. One thing I've learned over the last several months is that farms that are in that 200 to 299 range that have filed a notice of termination are being actually checked by DEC inspectors before they exit out. And again, the idea is to check and make sure that it appears that they're not discharging, and that's the condition that would allow them out of the permit. A bit of good news with this situation, I feel my observation, and in talking with some producers, there are farms that have been sitting under 200 cows, looking at that glass ceiling at 200, who have in fact gone forward and made the shift and are building cow numbers and over that 200 cow mark, taking advantage of this opportunity to grow a little bit, and also hopefully position themselves for investments that are going to need to be made if they continue to grow with regard to CAFO. On the permit side of things, we were expecting new permits, or at least draft permits, to be noticed late December. In fact, what happened is we just have been given the same existing permits have been noticed to us. Without going into a lot of details here, what's going to happen is it looks like the existing permits are going to be in existence and reapproved for July 1st, 2014, with the idea that they will be changed shortly or some period of time after July 1st, 2014. And this basically allows the state and the folks that are working with the state, such as many of the dairy organizations like NEDPA, Farm Bureau, ProDairy, to take a little more time and be a little more thoughtful with redrafting these permits. So the language is not available yet for what those will look like at the end of the day, but it is being worked on, and when those permits are available, there'll be lots of information circulating on that. So again, the idea of delaying new permit language is to give additional opportunity to clarify expectations in the CAFO permit, hopefully improve predictability for operators, and overall this is, I think, a positive development for folks in New York who are operate under a CAFO permit, and I think we should see this again as good news and a sign that this administration is taking our issues seriously. Just want to remind folks that, again, New York has two CAFO permits. One is a state issue permit, also called the ECL permit. The other is a federal or CWA permit. We do anticipate that the CWA permit that we ultimately end up with here, either in late 2014 or possibly 2015, will mirror requirements for the CWA permit set forth at the federal level. And one of the things that has been a real challenge for most of us, including producers, to get their minds wrapped around are the public notice elements and the high level of detail that is expected to be shared and made available. For this reason, once we see the two new New York permits, once we see them come out, I expect the possibility that there'll be a lot of large CAFOs that will migrate from the Clean Water Act permit into the ECL permit. Once again, we need to see the final language of both permit options to properly evaluate, but that's a decision that I think will be coming up, if not within the next year, certainly shortly thereafter. We also saw some new rules published in 2013 regarding the use of food waste products, particularly whey, with all the Greek yogurt that's being produced and the additional whey that's generated from that process. There's been a lot of whey moving around and being used in various formats, a lot of it being fed. Some of it's being land applied, some of it's being added to manure storages directly. And one of the, I think, useful policy change in the state of New York is it is clear now that CAFOs, because they have a fairly extensive nutrient management plan, as long as the additional nutrients brought in by way fit in the plan and the land base associated with that farm, no additional permit requirements are needed for the most part for CAFOs that are receiving whey that's being land applied. For other operations, non-CAFOs, smaller farms, and crop farms that are land applying whey, the standard Part 360 permit remains in place. So there are additional clarifications for land application of whey and other what we call non-recognizable food waste. They'll be coming out, I expect, in 2014. A little bit more on CAFO, and then we'll switch over. At the federal level, been a lot of activity. There was a Maryland poultry farm that was sued by an environmental group. West Virginia poultry farm was being sued by EPA. The Maryland suit was tossed by the courts, and EPA pulled or dropped their suit on the West Virginia poultry farm. There's a great deal of frustration both at the with farm groups and farm organizations about this effort to try to enforce CAFO, as well as there is frustration on the part of EPA. I was not sure where ultimately this is all going, but I just saw this week the Government Accountability Office released a report that was looking at the Clean Water Act and has recommended reforms that specifically identify agriculture, particularly non-point sources or field applications of manure, for example, recommending that these areas get more attention in the Clean Water Act and with future regulations. So nothing cast in stone there, but that's the first time I've really seen this type of analysis in print, and maybe that gives us a view for what might start to develop over perhaps 2, 4, 6 years or more down the road. Just a quick note on the Chesapeake Bay watershed and reminder, there are parts of 18 counties in New York State that are in the Chesapeake Bay watershed. Chesapeake Bay is trying to implement a TMDL for nitrogen, phosphorus, and sediment. TMDL stands for total maximum daily load. There's a lot of pressure on all sources of nitrogen, phosphorus, and sediment in the Chesapeake Bay, in New York, and the other Bay states. And just want to remind folks that if soil and water district personnel contact you and they're trying to do surveys of the best management practices that farms are implementing and have implemented, just urge farmers that receive those requests to participate, because the more practices, best management practices we can document here in New York, this is going to potentially help us prevent more strict controls or attempts to enforce more strict controls down the road if we can improve the good job that we're already doing. Another new thing that cropped up here this fall on my radar screen is that New York State DEC is moving forward with a total maximum daily load requirement for Cayuga Lake. The focus is on the southern end near Ithaca. The south end has been impaired by phosphorus and sediment for many years. It's been on what they call a 303D list that is the state is required to submit to EPA periodically. One interesting thing is that while the focus is on the south end and on phosphorus, there is some discussion about looking at the watershed and the contributing waters lake-wide here, and so that would potentially pull in a lot more agricultural operations. This is one we just need to watch and see how this unfolds. Really quick slide on air emissions and dairy and the air emissions consent agreement that a number of New York and other operations signed several years ago. We have no new information. EPA, I'm assuming EPA is still working on things, but there's nothing new here. The consent agreement remains in place for those operations that signed it, and then as long as you're following it, you're continue to be protected. And of course, as soon as we hear anything on our end, ProDairy will have outreach and provide information to producers on that issue. Another quick reminder, New York introduced requirements for reporting water usage. If you use more than 100,000 gallons per day in any 30-day period, you're supposed to report. The reporting deadline is March 31st of 2014 for reporting 2013 water use, and ProDairy does have a calculator and reporting instructions. We do have to make some updates to accommodate DEC changes, and those should be taken care of shortly. Okay, so let's talk about OSHA and what's going on. Just a quick review. Last August, OSHA folks in New York reached out to the industry and announced that they were going to be putting together what's called a local emphasis program. In response to that, folks from ProDairy, Northeast Dairy Producers, Farm Credit, Farm Bureau, Cooperative Extension, and also the New York Center for Agricultural Medicine and Health got together and put together a work group to try to address these issues. Just want to remind folks that OSHA is prevented by Congress from using any of their funds or their money to enforce OSHA rules on small farms. And at this point, those are defined as farms with fewer than 11 total employees in the last 12 months. There's also, those farms are exempt as long as they do not house temporary labor. And there's what temporary labor means and how OSHA is interpreting this is a little bit gray, and we are working with state and regional OSHA staff to try to get some clarification on this issue, and that's something that will circulate once we get better definition on, I hope. I do want to emphasize that it's important for producers to understand or determine if they are subject to OSHA enforcement, because there'll be a number of things they're going to want to work on if they are in fact subject to OSHA. And certainly if you have 11 or more employees, you are potentially, OSHA rules are potentially enforceable on your farm. I also want to, for folks that are outside of New York, this is not just a New York issue. OSHA can get on any farm in any state if they have 11 or more employees, or they house temporary labor, and there's a death or catastrophic injury. They can get on your farm. If they happen to be driving by and see what looks to be imminent danger, they can get on the farm. And if there's an employee or neighbor complaint made, and lastly, they can get on a farm through a local emphasis program, and that's how they're broadening the inspection process here in New York. OSHA has had a dairy local emphasis program in Wisconsin that was announced in 2011. There have been about 60 farms inspected over the course of 2012 and 2013. And again, OSHA in New York announced a similar program, and that is officially published in late 2013. So this local emphasis program, what that means is OSHA of the category here, dairy farms, OSHA will randomly select farms. They will determine once they visit if that farm is subject to OSHA enforcement. For example, confirm that there are more than 11 or more employees there. The inspection will be comprehensive, means they can go to any place on the farm, presumably, within the farmstead that they would like to. They're going to be mainly enforcing the dairy dozen. And if you don't know what the dairy dozen is, the Farm Credit East website has an excellent webinar that was put together several months back that will help get you up to speed on that. We also have received information that inspections by OSHA of dairy farms in New York under the local emphasis program are expected to start in July of 2014. So a couple of websites here. The New York Center for Agricultural Medicine and Health has been in the business of providing safety training for many years. I'm sure many of the listeners on the line here have heard of NICAM and have certainly used their programs. The OSHA work group worked with NICAM to develop a binder, a set of outlines that addresses all the dairy dozen areas. This has been reviewed by OSHA staff and is a pretty good place to start for farms that think they need to get ready for possibility of an OSHA inspection. And there's additional information at the OSHA.org website. Just to wrap up, for my comments, really these OSHA inspections are going to require producer focus. Someone on the farm, I believe, is going to have to really take the bull by the horns here and pay attention to this issue. Just even if you're not in New York, you're not off the hook. There's some rumors that other states will be developing local emphasis programs for dairy. And again, if you're more than 11 or more employees and there is injury or death or complaints, OSHA could come on your farm as well. And of course, safety review is a good idea for any farm, whether you're subject to OSHA inspection or not. There's several important CAFO permit decisions looming for large operations. You may be wondering whether you're going to stay in the Clean Water Act permit or switch to the ECL permit. There are very few large CAFOs that are actually in the ECL permit at this time, so there may be a big migration coming up in the next year or so. And for those that are in that 200 to 300 category that have a permit, should they stay? Should they get out, maybe grow, and then come back in at 300? A lot of questions there that people have been grappling with and will continue to do so. I do want to put a plug in also, the Dairy Acceleration Program. As many of you know, there are funds available for business planning and for comprehensive nutrient management plans. Just the other day, there were more funds announced by the state that will go into this program. And a new twist here, we're looking at providing some assistance for engineering designs that are part of requirements in a comprehensive nutrient management plan. There are no, we're not ready to accept applications for those monies yet on the engineering design side, but details will be forthcoming here in the next few months. Okay, that's all I have for the moment.
Karl, thank you so much for sharing that with us. You covered a lot of different issues there in a relatively brief amount of time, again, in a very clear way. These are emotional issues. They're not the types of issues that most of us come into work every day looking forward to dealing with, but clearly pretty critical to being successful in the farming business nowadays. So thanks for that. We're going to hold questions until Bob Smith has spoken, and then we'll take a few minutes and do text chat questions for either Karl or Bob at the end of the program. We're going to go to Bob Smith. I don't think he needs a lot of introduction. Certainly his pedigree is there on the background. We'll tell you a quick story and then turn over the mic to Bob. A group of us were working on this agenda back in a month or so ago, and we got to this particular point, and somebody said, well, you know, we really need somebody who knows what's going on in D.C. To do a Washington update, and we floated around a few names. They were very good names, and but I turned to Bob and I said, I don't know why it wouldn't be you, Bob. Nobody knows what's going on in D.C. any better than you do. And so he very, very modestly said, well, I guess I could do that. But as it turns out with Bob's schedule, he actually is on a phone in Washington, D.C. He's been down there doing some work this week, and we're all counting on him to get the Farm Bill wrapped up. Right, Bob? So take it.
Thank you very much, Jim. I appreciate the opportunity to be on. Yeah, we wish we could wrap up the Farm Bill. We thought we were going to report that it was wrapped up. We thought we would report that it was wrapped up, but at this point in time, we can't quite report that. Can you hear me okay, Jim?
We can, Bob. You're coming through loud and clear, and your PowerPoint is up.
All right, very good. Pleasure to be with everybody. Again, greetings from Washington, D.C. I'm going to go through some slides very quickly. I don't think there's a whole lot of reason to spend a lot of time on this. I know it's getting late in the webinar presentation. Let me just start out. You know, this is the second session of the 213th Congress. Keep in mind the politics. The Republicans control the House. The Democrats, 55 Democrats, that includes 2 independents, King of Maine and Sanders from Vermont, but caucus with the Democrats. Democrats control the Senate. Going into the fall, you know, keep in mind that 435 members of the House, all members of the House, and 33 senators are kind of in the back of their mind, or in the front of their mind probably. You know, they're going to face election this fall. What are the issues? You know, what are they going to be faced with? What are those hot-button issues back home? Certainly, we're dealing with a very polarized Congress. On average, Republicans are probably more conservative than they would have been 10, 15 years ago. On average, the average Democrat is probably more liberal than it would have been 10, 15 years ago, largely due to gerrymandering, but a number of other issues as well. The number of middle-of-the-road members of Congress, good or bad, just seems to be a lot less. Therefore, reaching consensus, reaching agreement on issues can be very tough. Oops. Okay, Christy, I'm trying to push this forward and it's not going.
Just click right on the slide.
I'm sorry?
No. You click right on the slide, otherwise I'll just take control and go through.
Okay, gotcha. Okay, sorry about that. We go into 2014, apologize. We go into 2014 with a lot of unfinished business. These are all issues that a year ago congressional leaders would be getting done in 2013, none of which got done in 2013. And we'll go down through these very quickly. The one that is wrapped up this week, just last night, the Senate passed an appropriations bill. The House passed it the day before. So we have an agreement on appropriations measures that was based on a budget agreement that was done in December, and that takes us through the end of September. To reach that agreement, they added about $48 billion on to what the sequestration package had previously provided for in the year 2014 and 15, years 2014 and 15. The issue that's coming up, though, that you're going to hear more and more about as we head toward early February is the debt ceiling issue. The debt ceiling current number is at $16.69 trillion. We're actually over that right now, but they suspended the debt ceiling back in action that was taken in October until February 7th of this year. So there has to be an agreement on the debt ceiling number or a suspension of the debt ceiling limit sometime in February, probably early February, or we will have more and more questions being asked. What's not going to get paid? How are bonds? Are we going to pay our bonds, et cetera, as we heard last October and previous to that as well. Bottom line is one would think that lessons are learned, that it's unlikely that this will be the showdown that it's been in the past. But until we go through it, I'm not sure we really know that at this point in time. Don't expect any government shutdown with the appropriations bills done. The debt ceiling issue really doesn't play out quite that way. It plays out to what's not going to get paid, essentially. But so we don't expect any government shutdown as a result of that. Certainly there could be some financial market disruption associated with the debt ceiling issue, but members I talked to suggest that that's going to get done without a real lot of major problems sometime in early February or the middle of February. You know, Mark Stephenson talked a little bit about the dairy provisions in the Farm Bill. You know, it's been an interesting ride, if you will. The areas of disagreement, there's been more areas of disagreement than I think have made most of the press. Certainly the nutrition title they're going to take about $8.8 billion out of the nutrition title, out of food stamps. That's based on about $780 billion in spending over 10 years. They're going to remove about $8.8 billion over 10 years there. The deal's been cut there, at least that's what I'm told. On dairy policy, Mark's already covered it. I won't cover it. I think he's right on with the proposed compromise. It's probably not going to be the market stabilization program. I think Speaker Boehner has stood very tough position in that regard. And so I think what Mark mentioned is most likely to play out. There's certainly been issues relating to crop insurance. We're likely, though, to have a very strong crop insurance program coming out of the Farm Bill deliberations going forward. That's where most of the funds that support agriculture will be going. Certainly not farm programs, but really into crop insurance. I won't cover this in any detail. I think you know that the current Farm Bill, or the Farm Bill provisions of the previous Farm Bill, have expired by now, some on October 1, some on January 1st. That reverts back to permanent law. But to really implement permanent law, USDA would have to take a number of different actions. That's not going to happen. The House did pass an extension of the current provisions. The Senate wanted to keep the pressure on getting a Farm Bill done, so they did not. So again, expecting that a Farm Bill probably will get considered when Congress comes back. They're on break now. They're out on recess until the week after next. But that the final provisions relating to dairy get worked out, a couple other issues on payment limitations get worked out, and Congress votes on a Farm Bill that last week of January or very early February is what I think we're looking at the current time. I just put this in just a reminder to everybody where the dollars go. This is actually on the January 2000 baseline a year ago, but it was a baseline that Congress was looking at when they developed the current Farm Bill provisions. You know, about 77% was going into nutrition, food stamp program primarily. That's probably going to be closer to 80% when we get done with the current bill. The crop insurance program at 8.9%. That probably will be over 10%, I think, in the spending under the new Farm Bill. And commodities, which are really farm programs, which at one time, you know, had a big role as far as the dollars go, or significant role anyway as far as the dollars go, will probably be under 5%. Of the funding as the Farm Bill plays out with the bill that one would expect might get passed again in the next week or two, or next 2 weeks. Let me change to obviously a very critical issue that's facing American agriculture, one that we've worked on a lot, one that a lot of Northeast producers have, and that's farm labor immigration reform. You know, I don't have to give you the background on it, and so I'll skip the first three bullets, but it's obviously a critical issue for labor-intensive agriculture. The Senate did pass comprehensive immigration reform in June of 2013. I think what the other good thing that we saw more and more play out in 2013 was involvement of other groups, not just agriculture groups, not just the traditional business groups in this, like the high-tech industry, but you see groups associated with churches, law enforcement people, as well as other business folks stepping up and saying this is an issue that must get dealt with. From an agricultural standpoint, the Ag Workforce Coalition, which Farm Credit East is a member, but many groups, Farm Bureau, National Council of Farmer Cooperatives, many other groups, U.S. Apple and so on, are part of, ended up negotiating an agreement that was part of the Comprehensive Immigration Reform Bill, establishes a new guest worker program, which is a far more flexible program, and provides adjustments of legal status for the current workforce. Along with that, though, we certainly anticipate that if comprehensive immigration passes, we're going to be looking at an e-verify system as well as continued tough enforcement practices on immigration. The House, of course, has taken a different approach. They're taking a piecemeal approach. They've taken different issues, dividing them up, if you will. Included in that piecemeal approach is an ag bill, and we may see action on this mid-February, late February, March. At least there's a lot of members that hope that will be the case. We will see. It also provides a new guest worker program, provides for USDA oversight, as does the Senate bill of that guest worker program. What it does not do, and what's a big concern with, is it lacks an adjustment to legal status provision like the Senate bill. So it would require any existing workers to go back to their country of origin, then sign up to be a guest worker in the U.S. in order to come back. Big announcement this week in D.C. was that Speaker Boehner has promised or has indicated that he will be releasing his immigration principles over the next 2 weeks, so outlining what he thinks needs to get done. That hopefully is a step toward progress here. We will see. But again, that was an announcement just came out yesterday and the day before. I just put this ad in. This is an ad by the Ag Workforce Coalition. There's many other ads they've run in various D.C. publications, Capitol Hill publications, talking about how what we will lose if we don't address this issue. So the real question on the politics of this, is, will the president really agree upon a piecemeal approach? Is he willing to do that? And really, can the House pass anything on immigration other than border security provisions? How many Republicans will it lose? Well, they're going to lose between 60 and 70. That means you have to pick up some Democrats. And then the question becomes, will Democrats support something less than the comprehensive provisions provided in the Senate bill? Bottom line on this, from an agricultural standpoint, watching the issue for many years, agriculture is clearly winning on the merits of this issue, and we're clearly improving on the politics, but we haven't won the political situation. There's still too much polarization, hard to get people to the middle on this issue, and that's what we're going to have to do if we're going to be successful. Let me hit a couple other real quick issues. There was a period last year where Congress was talking about major tax reform measures, reform of the tax code in a way for simplification to address a lot of inequities that many people feel are in the tax code. That's really lost steam in the last couple months. Senator Baucus from Montana is leaving Congress. He's been a real champion behind it. He's going to be ambassador, I believe, to China, and that's really put a damper on that whole issue. Unlikely it would have moved ahead anyway. Associated with that whole issue are 55 tax extenders that many of you are aware of that get added on or considered by Congress, including Section 179 depreciation, bonus depreciation provisions as well, that were not done at the end of last year or early this year. It's very uncertain when they might be considered. At least one person that's pretty knowledgeable in this area suggested to me that it wouldn't get considered until after the elections, which from a standpoint of providing an incentive out there for investment, that's kind of crazy to do in December after the entire year is used up. But that's Congress, if you will, on this particular issue. It may happen before that. We will see, but the timing on extenders is very uncertain. Food Safety Modernization Act, a lot of folks are familiar with that. Passed in 2011 as legislation. The Food Drug Administration has been developing the regulations on that. They went to public comment on regulations, a number of different regulations last year. The comment period, I believe, ended mid-November. Recently have announced that they're going to repropose regulations probably early summer for another public comment period. So that's good news. That's good news that they will look at those comments, rethink the approach being taken in some areas, and go back with another approach, because they are under a mandate to do so. Go back with a different approach that may be less burdensome for some producers. One of the issues to watch, in my opinion, is GMO labeling, genetic modified labeling. Bills have been introduced in Congress on this, and they're not going to go anyplace, make no question about that, certainly not in 2014. But there is state activity in a number of states. Connecticut passed legislation. I believe Maine has passed legislation now, I believe recently signed by the governor in Maine. Both of those are based upon a number of other states passing legislation. But that whole issue is certainly picking up attention. Two states, Washington, California, beat ballot initiatives on this, where the industry, the food industry, was able to overcome the proponents of this and successfully beat back ballot initiatives. But it cost $45 million to do so. And so that issue is one to watch, and there may be a move to do some kind of voluntary labeling system relating to GMOs. Let me just summarize then very quickly. Don't look at any government shutdown this year. I just don't see that happening. We have to watch a debt ceiling issue in early February, mid-February. Again, I think lessons learned suggest that that's not a good issue, maybe to not reach an agreement upon. Farm bill outlook, yeah, I think it's very likely we get a farm bill. I think they're down to a couple issues, maybe just one issue, and that may have been settled now, the dairy issue. But we're not there until they actually do the vote. And it could be closer in the House than we think. So we got to watch that one very close, but I'm going to be a little surprised if we don't get the farm bill done. Immigration, guest worker issue, I think we made great progress over the last year, but the politics remain very difficult on that issue. Speaker Boehner announcement of releasing immigration principles may be good. We'll have to see how that plays out in the next 2 weeks. Tax reform, very unlikely, and we just simply don't have a good understanding at this point in time of what's going to happen with the tax extenders. Food Safety Modernization Act regulations, again, we will see version 2 later this year. I'm not quite sure if that will be all across the board or if that will be selected areas. And we got to keep an eye out on GMO labeling and the implications that it has for agriculture. Jim, back to you.
Well, Bob, thank you very much. You covered a lot of real estate there in 15 minutes or so. Great comprehensive overview of everything that's going on in D.C. and I suppose a lot of things that frustrate most all of us as to the pace with which Congress is dealing with them. But with no further ado, I want to, I've got one question for Karl and one for Bob, and then a comment from one of our participants. I'll go with the comment first, and it is, as a note of interest, the Connecticut River Blueway and the Great Bay in New Hampshire will most likely eventually mirror the same oversight and compliance for TDML provisions as the Chesapeake Bay River Watershed Act. So that will be visiting us here in New England as well. Question, Karl, for you. If you file a water usage report, is that subject to FOIA?
Yes, I believe so. So anything in the government's possession, virtually anything, unless it's confidential business information, is potentially subject to FOIL. You can claim CBI on this. The state has said that maps of well locations will not be distributed, but the other information potentially is.
So your neighbors could potentially file a request and get that information released to them as the practical result of that, correct?
I believe that's correct, yes.
Bob, I know you could do 2 hours on this, and I'm going to ask you to do a couple minutes, but I know it isn't over till the president signs anything, but you know, is there some sort of a lesson learned out of the Farm Bill odyssey of the last more than a year in your mind that is instructive to us going forward?
Well, Jim, I don't think there's any question that it really is a different playground, different landscape out there on farm policy. And it's made different by a lot of different reasons. You know, the old idea of marrying those interested in nutrition with those interested in farm programs kind of broke down this past year. You know, we used to take members, urban members from nutrition, put them with rural members, and that would be the driver to get the Farm Bill done. What you saw was, you know, a number of different things. A number of members, Republican members with large agricultural rural districts are far more concerned about the level of government spending, you know, the growth of government spending, I should say, the level of the debt, and really less interested or less concerned anyway about farm programs per se. When you get into that kind of situation, that kind of starts to erode it. Then the urban members say, "Well, heck, you know, you're going to cut my programs. I'm not going to support yours." So it's going to be interesting going forward to see 5 years or 4 years from now, when we do another farm bill, how that plays out again. You know, and whether we keep the food stamp program as part of the ag program, and if we don't have it as part of the ag program, can we pass anything? As it relates to agriculture programs. Can we pass a strong crop insurance program if we didn't have food stamps with it? So I think we got a lot of soul searching to do in the ag community on that whole issue. And, you know, the polarization clearly plays a role here without getting into detail. So, yeah, Jim, big changes coming. Our landscape has really changed. Whether or not we go back and we kind of pull this back together, this urban-rural kind of, you know, coalition, or at least understanding of each other's needs for future farm bills, or whether this continues to divide. Not really sure how that plays out, but I think it's one to watch very closely and be involved in over the next few years.
All right, I really want to thank both Karl and Bob for, again, a lot of great insight and information here that helps us plan and figure out what we got to do in our businesses here in 2014. I do want to share one other text chat. I think it's more of a comment than it's a question for all of us, and I'm going to treat it as just a good insight from a good friend in New Hampshire. And it's in regards to the GMO controversy. The misinformation campaign impact is potentially much greater than the labeling itself. How will the dairy industry handle increased questions about genetically engineered feed? So I'm going to put that out there as food for thought. It's a great question, I think, for all of us to think about, especially as we go back to our respective organizations and businesses. With that, I am going to take a minute or so and close out, turn it back over to Chris for final comments. 3 things in terms of closing out. For those of you who are large employers, we are sponsoring 4 regional on-site seminars dealing with the Affordable Care Act compliance first week of February. Information is available on our website or through your local office. But boy, if you've got over 50 employees, you need to be paying a lot of attention here. If you've got 40 or above, or you're not sure if you're in that 40 to 50, would strongly encourage your participation. We've got a national expert on impact of these provisions on agriculture, and it will be at 4 different regional sites throughout the Northeast. I think we already plugged the Pulse of Agriculture survey at the beginning of the program, but really appreciate it if you would take 10-15 minutes. There's no showstoppers in there. Just you should be able to sit there and give your best viewpoint and click your way through that. So we certainly appreciate that. And finally, more generally, on behalf of all of us at Farm Credit East, use us for all we're worth. Yeah, we do the basics. We make loans, do your tax return, provide tax consulting, business consulting, benchmarking, crop insurance. I won't go through the whole list. but we provide these webinars. We provide a lot of individual consultative type services through our local branch people. I was in the Geneva branch this week. We were doing a Generation Next program with a group of young producers over there. So there's a lot of those things. Make sure you use us for all we're worth to be a good partner in your business. With that, I'd like to hand it back to Chris Lawton for the wrap-up to the webinar.
Okay, thank you very much for attending. Just a couple of closing notes. Several people asked about the presentation materials today, the slides and recording of the webinar. That will be available later on at farmcrediteast.com/webinars. We always post our upcoming webinars as well as information on and recordings of past webinars on that page. And the information on the Affordable Care Act, the Obamacare seminars that we're going to be doing in early February, that's available on our homepage. So I'd encourage you to, if you have any questions about that, to attend. The seminars are free and they're in person, and I guess that's about it. Thank you very much for attending, and we're adjourned.